Good afternoon, everyone. Bill Nelson with you from the Pinnacle Institute. Just double checking if you could just type in the chat if the sound is coming through okay on your end. I would certainly appreciate it. So we'll just take a quick pause for that. Anyway, glad to have you aboard. I know some of people, the time of this session is in the middle of the day, and many folks will catch the recording. So, a special welcome to all of you that are tuning in at a convenient time for you. So, lots going on in the markets, and I wanted to take this afternoon to talk about some strategies or some approaches. We can't cover every single one, so we can only say take one or two strategies that we can apply. And the other thing is, we will be applying the Pinnacle method to the stock charts. Um, and so you can see how we apply what we teach to our members and apply ourselves to the stock charts. And so I'm kind of giving away the store a little bit, and that is in times of greater volatility, we can. There's no reason necessary to abandon the stock market. So, but there are some things that we can do. So let's talk about that. Before we do, I want to make mention of our upcoming workshops that my good friends Steve Moses and Sam Seiden are hosting here at Pinnacle. Coming up, we have a session tomorrow for those who are new to trading and investing and are unfamiliar with our supply and demand trading strategy. And I can tell you what we're about here at Pinnacle is identifying with high probability the areas on the stock chart that represent an imbalance. So then when price returns to that area, we should see a reversal and then price go back in the direction that it came from. So, our introductory workshop for those who are new to that philosophy and strategy, we have one coming up tomorrow, Saturday, December 11th at 10 a.m. Another one Tuesday, December 14th at 11, and then again next Saturday, December 18th at 10 o'clock. Meanwhile, we do recognize that with Sam and many of us in Pinnacle, the concept of supply and demand being applied to the stock charts has been around for a while. Sam is actually the one that introduced that to all of us, and that has just been fantastic. Sam is hosting an event tomorrow at 10 a.m. and then Wednesday, the 15th at 11, and then next Saturday again at 10 a.m. And again, that is for those who have had an exposure or some familiarity with supply and demand. And so we invite you to sign up. And the way you do that is go to pinnacleinstitute.com/upcoming events. So anyway, hope to see you in one of our upcoming workshops where we will cover the basics of the Pinnacle method and how it's applied to the financial markets. Before I can go any further, I want to share the risk disclosure, obviously, for any of us that are talking about the financial markets. I want to cover this, and these are the disclosures, which are simply this: you agree and acknowledge that all trading comes with risk, and you acknowledge that any of the products or services offered do not come with a guarantee of success. You agree and acknowledge that the Pinnacle Institute did not and does not make any money making claims, and that any analysis given gives no guarantee of success in the stock market. As all of you know, trading and investing in the stock market carries financial risk, including and up to the entire loss of capital. And point C here, the Pinnacle Institute cannot and does not independently verify, assess, or guarantee the validity, adequacy, timeliness of or suitability or profitability of any particular security or investment. And anything that we cover, and I will have dozens of ideas here for you in terms of levels in the stock market. You need to decide for yourself whether any one or all of those investments are suitable for you, and they are presented entirely for educational purposes only, and that you bear sole responsibility for your own investment research and decisions. And should you desire, seek the advice of a professional who owes a duty to you to provide economic and financial counsel to you. All of the material that we are providing is copyrighted and owned by the Pinnacle Institute. And again, comes up less, but our FTC commission guidelines as it relates to money-making claims. We do not make money-making claims unless we have the documentation, bank statements, account statements, and that they have been verified in advance of making any of those claims. So, one other point, available research data suggests that most day traders are not profitable. And again, you acknowledge and agree that the Pinnacle Institute did not make money-making claims, and that any analysis given gives no guarantee in the stock market. Okay, now that we've got the lawyers satisfied, we can move on. So, what goes up must come down, right? And that is maybe less true in the stock market, but as we've seen, we've had a nice run up in the overall stock market, which the SPY is our best example of what the overall market is doing. And so with that, what goes up must come down is so more true with the laws of gravity, but less on the financial markets. But corrections do occur, and as we can see on the SPY, and just you guys can see the SPY chart, right? Just want to make sure we're all on the same page. Anyway, so I think you can. So we can see that there have been when I say a number of corrections over time, and this is the kind of volatility of late that we have seen here in the stock market, where coming through the COVID example, almost now, I hate to say it, but certainly over a year, and impressing maybe a couple of years, but in either case, we have seen some greater volatility in the markets. We've had some other contributory factors, at least another significant contributory factor in the markets of late, and that would be, I'm seeing if anyone in the chat would type, which is okay. Inflation. And something that we've talked about a lot here within the various forums and things that we do here at Pinnacle is, talk about how it does seem that inflation really, it's almost like someone just hit the switch. We were flirting with the 2% rate here in the United States. And then literally almost overnight, with the supply chain issues related to COVID-19, pushing prices up. But the Fed Reserve, Jerome Powell, had been saying, even with some of those early indications, that the inflation that we're seeing is transitory, meaning temporary. Once we get the supply chain issues figured out, everything is going to drop. Well, the fact is we really don't know. The point is that wages and Certainly in the service sector, wages have gone up quite a bit, and those are less likely to fall so quickly. And other aspects of our economy here in the US have gone up as well. Obviously, our oil prices and housing prices are the next big categories. So across the board, we've seen some price increases, but in certain sectors, quite a bit more than others. And so that kind of makes. I don't want to say that this time it's different. It's a term that here at Pinnacle we do not say a lot because typically we have seen much of this before, and I join that viewpoint. In either case, we are seeing greater volatility in the markets. Markets are once again, the financial markets are flirting with their all-time highs. The one thing that we are mindful of is the fact that quality opportunities to get in, if there is a pullback, are much lower from where current prices currently may be. That being the case, and given the fact that the price, as we can even see here on the SPY, just in terms of each of these individual candles is a day of trading in the SPY of the New York session. So just 6.5 hours of trading. We can see that just over the last 2 trading weeks, quite a bit of movement in the given day from the high to the low, which is, how should I put it, quite a bit bigger than what we've seen previously in this run-up. We can just compare the size of the candles to what it took on each day to move higher and higher, and now we have moved relatively almost twice as much in a given day than what has been more recently historically the case. And so that is another data point that tells us there's some greater volatility into the market. So, and as these corrections do, and we can go up from here, and that's another point that I wanted to cover this afternoon, is that we don't know yet, without this huge imbalance that could occur should we see a lot of selling come in the market. For now, we could see another leg higher. And that leads us to the conventional, we'll call it the conventional wisdom, but the conventional approach that money managers, maybe even your financial advisor might be telling you, is that in these kinds of times, you can move to cash. The other thing that many advisors will share is go ahead and stay in the market because it will come back. And regardless of how far it can fall from here, so just go ahead and stay in the market. Others might be saying, no, move to cash or move to a greater percentage of your holdings to cash. The other thing is diversify out of stocks into bonds and other assets. And depending on where you are in your trading and investing stage of life, some of this might still make sense. The issues, though, with what is typically recommended, and I'm in my low 60s now, so I'm in of a certain demographic for sure. The issues that come with that is that a cash-based position can result in missing those pullbacks to quality demand zones, which can push prices higher. And then as a whole, moving to and diversifying out of the stock market into specifically government bonds can put you behind inflation, meaning you're earning less than what, in other words, your money is worth less and less in that given investment, even if the bonds just go up the way they're estimated to. So with a annual rate of inflation now at about 6%, a government bond that's paying 1.5%, if you kept that in a government bond for a year, 6 minus 1.5% would still put you behind in terms of buying power with that money that you had at the beginning of the year by 4%. When inflation is hovering, at about 2%, that is less of an issue. So the conventional strategies of moving into bonds or just moving into cash, you can miss out on uh, new legs to the upside on the stock market. So the theme of today is not necessarily abandoning the stock market. There are some things that we can do. But more importantly, we can be a little bit more focused and strategic in terms of the kinds of trading and investing we might want to do going forward. And I want to present some ideas to you to keep in mind. So, with that, there are many financial strategies that we can apply in times of uncertainty. We can buy option positions, in essence, puts, to hedge those possible losses. So, in the underlying stock. So, if our underlying stock is losing money, having purchased a put, that actually gains in value. It's inversely correlated. So, the value of the put goes up if stock prices fall. This alone, buying options, and actually, if you look at one of our previous videos by Steve Moses, our options expert and instructor, he walks you through the high level components of how that is accomplished. So I invite you to check out that recording to get up to speed on how to buy options as a hedge. The other thing that many people do is they sell futures positions. Sell to open positions on the US indexes, maybe, and do so on some contracts that might be further out. And that is a way of protecting your investment. The other thing that we've talked about is diversify away from stocks into government and corporate bonds. And, and in the corporate bond land, we have to be careful. But there are quality corporate bond exchange traded funds out there that you can do, and they do typically a little bit better than the government bonds. And so that is something to consider. The other component, potentially instead of holding cash, is adding some commodities to your portfolio. That could either be, many people will use gold, but you can also use other commodities that that might go up in price or hold their value if the stock market were to take a dip. What we want to do, though, this afternoon is talk about these last three components. Adding commodities to our portfolio. We want to focus less on individual companies and potentially more on indexes and sectors. And how, in terms of the kinds of companies I want to talk about today, are the companies that have stood the test of time. They specifically, and there's a category of companies out there called dividend aristocrats. They are companies that have to be qualified as and it's an unofficial qualification, but to make the cut, a company must have raised their dividend every year for the last 25 years. And so that would be even during the times of COVID, even during the financial crisis. These companies have found a way to not only maintain profitability, but return that profitability back to shareholders consistently, and every year decide to increase those dividends. And so that alone might meet the definition of a quality company. And obviously they've been around for a while. Here at the Pinnacle Institute, and in the portfolio, the Pinnacle portfolio, which is one product offering we offer our members, which every Thursday evening we get together and we review our list of pending stocks And we have a very robust qualification and screening system for which companies make our list in terms of meeting our criteria for wanting to get in at a discount and holding that to target. One component is obviously a strong balance sheet. And a strong balance sheet means lower debt, higher free cash flow, and enough resources and the ability to continue to do okay or to do very well should should there be headwinds or a serious storm ahead for that company. And they can do so. Their strong balance sheet can reduces the risk of either removing the dividend payment or potentially forcing the company to cut its dividend payments. We look at historic volatility as another component. So one thing I can share with you is that there is something called beta, which on any profile that you could pull up about a company, it will have a number associated with beta. Typically, it will be between either a decimal point of less than 1 or something more than 1. And that is really measuring that company's stock price volatility as it relates to the SPY, the SPY. So the SPY has a volatility of 1. Companies that are deemed to be, or statistically their stock price is less volatile than the SPY, you'll see a decimal point, 0.50, 0.30, 0.89. That just means that that company's stock price is less volatile than the SPY. And then anything more above 1 means it's either slightly or greatly more volatile than the SPY. That's really it. It's a very one data point that we use to determine which stocks are worthy of our list for long-term investing. When we are day trading, when we are looking for a shorter opportunity, more of a short-term opportunity, we are looking at a vastly greater number of stocks that will meet that criteria. And then the one thing we do here at Pinnacle is we look to buy them at discounts. And the only way we can do that is the overall market is turning. The overall stock market is making a leg lower, including the individual stocks that make up the stock market. And we want to be ready and anticipate prices coming into our area that we've identified in advance, and using the Pinnacle method, have a high confidence that the level that we have selected will be a turning point. Okay? So, many of you tuning in today, I can only imagine that you're well familiar with the SPY, the Qs, the IWM, the Dow ETF, and maybe less so, but the MDY, the mid cap ETF. If you're new to trading and investing, let me just share. Exchange traded funds look like a mutual fund, but they are traded like stocks. Their value changes almost by the second or by the minute while the stock market is open. Whereas mutual funds, their value is set at the end of the day, and you open an account with your mutual fund, and it's very, very difficult to get your money in and out of your mutual fund very, very easily. And with mutual funds, you're paying, when we say high fees, you're paying a significant amount of money just to the managers of the mutual fund, and then all of the overhead that comes with that. exchange traded funds have typically lower costs associated with them. And with that, and their ability to, and the liquidity, meaning we can get in and get out very, very easily, and the lower costs associated with them make them a very, very attractive investment. And the one thing I just want to point out, certainly these are stocks, meaning, if there's a downturn in equities, we will see a downturn in, in these, certainly in these 5 and in other ETFs as well, depending on the kinds of companies and the various sectors that make up that particular exchange traded fund. But the point is being prepared for the potential of a downturn in the market and being ready to pick up any of these at a discount is what we're all about. So these are stocks. And again, one of the themes for today is if you want to diversify entirely out of the stock market, then this wouldn't be for you. To the degree that you want to stay into the stock market, but look for quality opportunities, then maybe putting some cash aside and waiting for your price is what we're about. And that's what we're recommending. Okay. So we're going to go to the live charts in just a second. So there are hundreds, if not thousands, of exchange traded funds, ETFs, and some of them have a specific purpose. You can invest in ETFs that are global or strictly international, strictly Europe, strictly Asia, strictly Japan, for instance. You can look to ETFs that they themselves are invested in only companies that are in the financial world. So our Goldman Sachs, JP Morgans, but then also our Wells Fargo's and US Bank, Morgan Stanley. Those would be part of the financial sector. And then in healthcare, that would be companies like Pfizer, company like Thermo Fisher, companies like AbbVie. Anyway, you can easily find in each of these ETFs what are the top 10 holdings, but then also what are the maybe 100 or so holdings that are in each of these sector ETFs. And many of these themselves can be defensive. And again, I'm repeating my point that in times of greater volatility, there can be defensive plays in the stock market, and we will talk about that. There are also inverse ETFs, and we're not going to talk about those today, but you can do that on your own, where the value of the fund moves in opposite direction of the underlying index or market. So if the market is going down, the inverse ETFs might have bought puts, and therefore they will make money when the underlying market is going down. That's just one example. There are even crypto ETFs. The overall benefit, though, of an ETF is the inherent diversification. And that is one single stock of an ETF shouldn't have a dramatic impact on the rest of the fund. So that is a component. I know many people whose retirement is not in individual stocks, but in just ETFs. And so what they miss out on is, buying Tesla maybe at 160 a share and seeing it go up to 1,000. But in exchange for that, they even out, the huge volatility and the huge moves that come with owning a handful of individual stocks. And so as much as the upside might be potentially muted, so can be the downside. And that would be the point. And so for long-term investing and for long-term investing, I was going to say long-term investing and trading, but in either case, it's the same. Following an approach where your fortunes are not tied to one or two companies might make sense for you. So that's something to consider. Okay. Here are these are the top 10, top 11 sectors that we are going to look at. The other component, and I've already talked about it, but I want to give you folks a graph on how dividends and companies that pay dividends can help over the long term. It's like a bonus on top of a bonus. So imagine picking up the SPY or picking up a basket of companies at a discount, but then those companies themselves will pay a nice dividend along the way. And with the power of compounding, you can see a dramatic difference. So there is something called the S&P total return, which takes into account dividends, and then the SPY. Both are, have done really, really well since 1989. But a dramatic return for not only price appreciation, but also collecting dividends along the way. So let's go to the charts. And let's take a look. So with the SPY at 469, and some of our ideas that we have are on the higher time frames, but just starting with the SPY, and even though it is at 470, if you will, 469, picking it up at 442 still would represent a nice discount. Should we see, obviously, 440 is around here. Should we see a major move to the downside, picking up the SPY, somewhere below 420 would also be a bargain, or maybe around 400. So that is, part of our strategy. Let's go to the Qs. In the Qs, we've had our eye on this area of 376 down to 372 off the daily chart. And should this area fail, looking down here at 347. The point is, this represents, just in and of itself off the daily chart, a nice 3, 4, 5 to 1 return between what we're getting in at and then potentially where our stop might be located. So this is your actual dollar risk. And so when we talk about a 3 to 1 or a 4 to 1 return, it's, we're not risking all $376, only the difference between 376 and 372. IWM, this is the Russell 2000. And so let me just explain a couple, and actually with these 5 ETFs, we've covered a good part of the market. So as I mentioned, with the thousands of ETFs available, we can get in with a scalpel and come up with ourselves, ETFs that will specifically meet our needs or the kind of companies that we're looking at. But within the overall stock market, one of the beginning tools that we look to when we're screening companies is whether adding up the value of all outstanding shares of a given company is something called its capitalization. And so companies that are, well, just the best way is to talk about examples. So the Teslas, the Apples, the Microsofts, the Googles, or Alphabet, or Meta, Facebook, Netflix, those companies are called mega caps because the value of all of those shares outstanding is in the tens of billions of dollars. And they make up a good part of the SPY, and they make up a good part of the Qs. The Qs is the top 100 technology-based companies. In essence, are computer software, but are highly technical companies from around the world, are part of the Qs. The reason I mention this is when we're talking about the IWM, the Russell, we are talking about 2,000 of companies that have a market value of about $2 billion or less. This represents the kind of companies that hope to make it into the mega cap land, in the tens, if not hundreds of billions of dollars in market cap. But for now, it's nothing to sneeze at. They're worth, $2 billion or less. And these are the top 2,000 companies that the iShares Russell, folks have decided that they can be part of this club of 2,000 companies. So that's what the Russell 2000 is. The DIA is the Dow 30. This tracks the Dow Industrial Index of just the 30 companies that make up that index. For the longest time, the Dow was deemed to be, the symbol for how the market was doing, when in fact it's only 30 companies, which is why we pay quite a bit of attention to the SPY. It's 500 companies. And then the MDY are mid cap. So imagine the disparity between companies that are worth $2 billion, the companies that are worth hundreds of billions of dollars. What about those companies that are worth between $2 and $50 billion, or $2 and $12 billion? Those companies make up the S&P mid cap index. Okay. All right. So that explanation out of the way, we can look at the IWM. I think we were here on the 240. And picking up the IWM at a discount. And again, a pullback, meaning prices are going to fall to reach our area of demand, or an area where we believe with high probability that prices will turn, is in this neighborhood. On the Dow, similarly, waiting for price. And if price doesn't get here, on the smaller time frames, we do within the Pinnacle Institute and with our members, we will look at areas in here as opportunities. So, so part of what we do here at Pinnacle is to look within these areas and themselves, see what the chart is suggesting, representing a discount, but maybe a discount on a smaller scale, given with where we are given with where current price is and where our entry point may be. But for our purposes for this session, we'd be looking at a nice discount of the Dow here at 331.50. MDY, Similarly, down here at 441 to 435. And we talk about within the Pinnacle Institute why opportunities within this area represent lower quality and lower probability. But there you have it. Let's go ahead and look at our sectors. The XLF, the financial ETF. Here at looking at an entry point here at 35.41. And our exit, meaning if we're wrong, our stop would be below 34.34. And representing really, a dollar or so of risk per share, with the idea that expecting prices to turn here. And if this doesn't work, this is the next area we'd be looking at. Let's look at the healthcare area. Looking at an area here of 124.73 to 120.78. We can see within, and so quite a few of our medical device manufacturers are part of the XLV, the healthcare ETF. Pfizer, Moderna, J&J, many of the other companies that are not just in, providing solutions for COVID vaccinations, but have a retail component to their product portfolio, as well as the industrial, meaning servicing hospitals and other components. So you'll see the reason I mention that is that if you pull up a list of the members of XLV, you'll see companies you've heard of and others you haven't. However, if you've had a hip replacement or a new knee, you might see the maker of that company, or you might even be a carrier of that product and maybe didn't know it. XLC, the communications sector. Not one that we talk about, but T-Mobile, AT&T, Verizon have been really on a weekly basis headed towards a long-term or a high time frame demand areas. And so we're seeing some of that reflected in the XLC communications sector. So in either case, we are seeing a footprint of supply, but more importantly, looking at an area to get in on XLC here at $64. And again, this is a way of thinking about and using ETFs as a way of, you're still in stocks, but it's a way of having you be less individual company dependent on your portfolio. Can these move up and down quite a bit in a major market correction? Absolutely. And if that is something that concerns you, then I would highly recommend you do your research on hedging or the other defensive things that you can do, such as, if you're afraid, moving to some of your positions into cash or bonds or the other things that are available to you. So I just want to be very, very clear as we're talking this afternoon that this is not an exception to a major correction in the market. What it is, though, is a way of, instead of having all that money parked out of the market and missing this opportunity, being ready to pounce on these discounts. So buying something on sale. That's all we're doing, is trying to provide all of you sale prices for these assets. And then these assets themselves represent some diversification. Okay. I know I've said it multiple times, but I just want to be very clear about what today is all about. So XLI is similar to the Dow, some greater diversity, some different components to XLI. And so we see the chart looking a little bit different. In this case, the chart is telling us a really good discount and a probable entry point, should we see a correction, is down here at $90 a share, from 90 to 88.50. XLY, consumer discretionary. The best way to describe consumer discretionary would be potentially, the makers of our flat screen TVs. It might also be Nike. Not might be, it is Nike as a component of consumer discretionary. So these are companies that with products that these are the companies with products of things that we want and less of the things we need. And so that's what makes up consumer discretionary. And so with that, looking at an opportunity here at 193 to 190. XLP are the products we need. The Kimberly-Clarks, the Campbell Soups, food, our supermarkets. And one of the things you can do, if you're looking at this and seeing a pattern here, what we're doing is looking away from where prices have been in a range and going beyond that area and using the Pinnacle method. This is what gives us the confidence to pick an area here at 65.87 down to 65.50. So this is a smaller zone for sure. But when we see our series of red candles coming down, we anticipate price having an easier time moving through this area. XLB, these are materials. These are the companies that, if you're anywhere familiar with the industrial area, these are the specialty chemical companies. These are the companies that make the front end of, I don't want to say the supply chain, but the front end of the manufacturing sector. These are the companies that make the plastics that go into so many end-use products that we have in our homes or that's in stores. So that's what the material sector is all about. And again, looking at an opportunity here at 75.27 to 72.34. XLK, very similar to the Qs. So and the chart looks a little bit different, but many overlap between the companies that we see in the Qs and XLK. Just a different manager of the fund, of the ETF. And looking at an opportunity here at 159 to 157. Many of you may be asking, well, Bill, we're going to have to wait a while for price to come down to this area. And my answer is yes. In trading it or in investing, we are willing to wait for price to hit our zone. Do we need to have our buy order set up months and months in advance? No, use an alert. You can put an alert on your chart or even in a third-party app, and have it be somewhere, above your price point to alert you to go ahead and put in the order. And those orders can stay in effect for a year, even maybe longer. XLU, let's go to, on XLU, we might need to go below March lows. Wrong chart. I apologize, everyone. There we go. The 240. So we're looking here on the utilities. So this would be the con eds, your natural gas providers from around the US, and looking at an entry point here at 62.82 to 62.14. Green Planet Trader, which ETF sector is likely to be most affected when, very, very good question. So in thinking about that, I would say the US indexes, or I would say the US, certainly the SPY reacting to the initial news. But then also the commodity sector, and maybe meaning of natural gas. That would be off the top of my head the components that I would look to be most impacted. Yes. And so speaking of the energy sector, and there are several, not just, so I just picked these handful of sectors. There are several more ETFs that are part of the energy area. The Oil Explorers ETF. So there's quite a few here. So let's look at on the daily chart. Looking at an entry point here at 44.74 to 42.88. By a percentage standpoint, somewhat significant, but in the big picture, 10, 12, $12 move. Yeah, you're a good point there. The utility sector and XLF, maybe, sure. As we, you raise a really good point. So given the fact, and something that we take into account are news events that can have an impact on price. But as you have typed into the chat already, well, what happens if Russia invades Ukraine? Some of that possibility is now really baked into the chart, baked into the that contingency. Could mean why prices had a muted day yesterday. And then if it really happens, or if it does, if it does happen, that could move prices a little bit. But our philosophy is that it could move prices not here on XLRE, because this is the real estate, but in XLU, XLF, and the other energy related sectors for sure. Here in the real estate ETF, looking at an entry point here of 42.42 to just under 41. The transportation ETF, looking at an opportunity here at 61.86 to 57.25. This would be a 30% correction in this ETF. When this is happening, And this can happen in a much quicker time than the run up in price, as we see fear has a tendency to really, really drive the market. This would be calling, the analysts in this market, in the transportation market, will be calling, we are now in a bear market. And we would see that across the board. If the markets drop 10% or more in any market, it's deemed to be a correction. That's the opportunity to begin, or that is our signal to begin looking for opportunities. Okay. And then one more we have time for is I wanted to let's cover oil and GLD, some of these commodities. On USO, with prices here at 51.59, looking at an entry point down here at 36 to 34.57. Chart is suggesting that there can be some opportunities higher up on these lower time frames. So GLD is one of the ETFs that is, this one is most directly related to the spot price of gold. And again, we'd be seeing an opportunity here at 135.86 to 130.52. This would be, gold and the commodities could be an area where you could be interested in trading that in futures as a hedge. And instead of selling to open, maybe potentially buying to open a position. And then silver. And this one using the monthly chart. Looking at opportunity down here at 17.15 to, let's just call it 15.5. Another way to offer some diversification into your portfolio. So many more to consider. We don't have time to go through all of these, but individual companies that are the dividend aristocrats. But I'm hoping, at least with today's session, to plant the seed that the stock market in a time of greater volatility is not our enemy, but it can be the the seed of opportunity for many of us, provided that we keep our risk in check and look to pick up things at a discount. When everyone else is selling, we can pick up some quality investments at a discount, get price appreciation, and then hopefully some dividends along the way as well. Okay, so we remain available here at the Pinnacle Institute. I hope you are interested enough to check out our workshops where we go into a little bit more detail of what the Pinnacle method is all about and what we are here at Pinnacle. But in the meantime, maybe I've given you some ideas that you can consider on your own. So with that, thank you everyone for tuning in this afternoon. It has been my pleasure, and we will see you soon. Thank you, everyone.